We move to question 4. Question 4. I wrap this, assuming we have taken it down. Okay, so we move to question 4 of the paper. Question 4 is all computation. Part A is testing taxation of insurance companies. Part B is testing VAT. So let's start with Part A. Riziki Insurance Company Limited was incorporated in the year 2019. The company deals with different classes of insurance. The following trial balance was extracted from the books of account as of 31st December 2021. So we have a trial balance balancing at 23,420,000 shillings. So it is a trial balance, meaning it has balances of assets and liabilities, it has revenues, it has expenses and all that. So it is upon us, therefore, to differentiate, separate the items that we need and only pick those that we shall use to answer the question. So we have a trial balance. Additional information 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. So this is a question testing taxation of general insurance. Remember, the activities of an insurance company could be in the form of general insurance and life insurance. So the rule is, where an insurance company offers both general insurance and life insurance or life assurance, then the two are treated as separate businesses and they are taxed separately. So this is on general insurance. And general insurance, again, can have different classes. Like in this case, we have motor vehicle insurance and fire insurance. So let's analyze the additional information. 1 says, claims intimated and outstanding as of 31st December 2021 amounted to 750,000 for motor vehicle insurance and 480,000 shillings for fire insurance. Now, claims are almost the major expense of an insurance company. So just like in any other businesses, we can have claims outstanding at the beginning and at the end of the year. So here we have 3 figures that we shall have to adjust for each of these. We have claims outstanding, that is accrued claims brought down, that is at the beginning of the year. We have claims paid during the year and claims outstanding or accrued at the end of the year. So in short, we shall have to adjust the claims account so that we determine the figure to the income statement. 2, an earned premium is maintained at 80% and 50% of the net premiums received for motor vehicle and fire insurance respectively. An earned premium is maintained at 80% and 50% of the net premiums received for motor vehicles and fire insurance respectively. Now, what do we do? In tax, the government taxes taxpayers on income earned, not necessarily what is received. So what we shall do here is simple. We shall work out the net premiums received. Net premiums received is simply total premiums received less premiums returned. In insurance business, as a company, you can receive premiums from your insured, but then because of certain reasons, may have to return. So net premiums received is simply the difference between the two. So what we shall do is simple. Determine the net premiums received, then deduct the unearned premium so that we only tax that which has been earned. 3, investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Investment allowances have been agreed with the commissioner at 1.2 million shillings for the year ended 31st December 2021. Now, this insurance company has non-current assets, like the first item in the trial balance is property, plant and equipment at 10.2 million shillings. We know this depreciates, but for tax purposes, depreciation is a disallowable expense. Instead of depreciation, we allow for what we call capital allowances or investment allowances, which are computed at a uniform rate for all businesses. 4, so we shall allow this as an expense instead of depreciation. 4, investment income analysis. So in the trial balance, we have an item they are calling investment income, a total of 4.15 million, sorry, 4,150,500. 4,150,500. So this is the analysis. 1, we have interest received from government securities, 2,040,000 shillings net. Net here means after withholding tax has been deducted. So interest received from government securities, 2,040,000 shillings net. Now, interest income is subjected to withholding tax at the rate of 15%. So net here means this figure is 85%. Now, the next thing is, how do we treat interest income received by a company? This is a company. Now, for companies, withholding tax of 15% on interest income is not final tax. So what we shall do is simply to gross the amount given, that is get 100% of it, tax the 100%, but when computing the tax liability, we shall deduct the withholding tax of 15% already paid. Next, we have interest received from local banks. Interest received from local banks, 760,500 shillings net. Net again means after withholding tax of 15% has been deducted. The treatment is the same. We shall gross the amount, tax the gross amount, deduct the withholding tax already paid when computing the tax liability. 3, we have dividend received from a Ugandan company. Dividends received from a Ugandan company. That reminds you to remember your treatment and classification of dividends. Now, this is dividend received from a Ugandan company, meaning it is a dividend income received from outside Kenya. The rule is that is an exempt dividend. So remember your classes of dividends. We have exempt dividends, qualifying and non-qualifying. So this being an exempt dividend of 450,000 shillings gross. Gross means without, or rather before any taxes. We shall leave it out as an untaxable income. We have dividend received from a local company of 900,000 shillings net. 900,000 shillings net again means after withholding tax has been deducted. For dividend income, withholding tax rate is 5%. So that means this is 95% of the figure earned. So this is dividend received from a local company. Now the correct classification is this is a qualifying dividend. So what we shall do is simple. Qualifying dividends are dividends whose withholding tax is final tax. So we shall not tax it again. We shall not tax this again because it is already net of withholding tax. 5. Fees paid to investment managers amounted to 750,000 shillings for the year ended 31st December 2021. Fees paid to investment managers. This is an allowable expense, and so we shall show it as one of such. Required: 1. Taxable income or loss for Riziki Insurance Company for the year ended 31st December 2021, and 2. Compute the tax payable, if any. So this is what we do. We say we are answering question 4A. So we show each class in a separate column. So we have motor vehicle insurance, motor vehicle insurance. We have fire insurance. Then we have total here. Then show the currency. Okay. So we start with the premiums. So if you look at the trial balance keenly, there are a number of items touching on premiums. So 1, we have gross premiums received from direct clients. So we can start with that. gross premiums received from direct clients. So motor vehicle, we have 3 million. Fire is 2.5. The sum should be 5.5 million. Next, we have gross premiums received from agents. So gross premiums from agents. Motor vehicle is 2 million. Fire is 1.2 million. That should be 3.2 million. You can get, if you go to the trial balance again, down, we have what they are calling premiums returned. That is premiums that were received from clients, but paid back again. So we have motor vehicle is 800. We deduct. This is 700. A total of 1.5 million. Another thing touching on premiums is whether here up to here we can get net premiums received. Net premiums received. So net premiums received is total premiums received less what was returned. So for fire we have, this is so motor vehicle, this is 5. 5 minus 8 is 4.2. So we write here 4.2 million. This is 37 minus that is 3 million, a total of 7.2 million. Then we use information 2 to work out unearned premiums. So we say less unearned premiums. That is 80 and 50% respectively. 80% for motor vehicle and 50% for fire. So we begin, we get 80% of 4.2 million. That is 3360. 3360. So up to there we can get earned premiums. So that will be 3360 from 4200. I get 840,000. We move here. 50% of 3 million is 1.5 million. Less that is 1.5 million. So total earned premium for the year will be the sum of the two. 840 plus 1.5. That should be 2340. This is 15 plus 3360. 4860. Good. Next, we add other taxable income. So we say add other taxable incomes. Add other taxable incomes. We only pick those that are taxable. So we make use of the trial balance and the additional information. One, we have what they are calling commission. Sorry, before we go to other taxable income, there's something else touching on premiums. We have what they are calling reinsurance premiums paid. That is, insurance premiums paid by this company to a reinsurance company. So we should deduct that so that we have what we call net premiums. So we say reinsurance premiums paid. So for motor vehicle it is 400. For fire it is 150. That is 550. So we get the difference again. We get net premiums. This is 440. This is 1350. 1350 plus 440 should be 1790. 1790. Up to there, we now bring in other taxable income. So say add other taxable income. So we separate the other incomes and only use those that are taxable. One, we have what they are calling in note 4 investment income. Investment income. One, we have interest from government securities. So we write here interest from government securities. So the amount is net, so we gross it. So we shall do 100 over 85 of 2040. We do that together. 100 over 85 times 4, 2040. That gives me 2400, 2.4 million. We add it here. Next, we have interest from local banks. Interest from local banks. The same process, 100 over 85 times 760.5. We do it together. I get 894.71. Yes. Dividend from Ugandan company not taxable. Now in exams, if you don't make use of any item provided in the question, please explain why under your notes and assumptions. So you can say under notes and assumptions, one, that dividends from a Ugandan company is an exempt dividend, hence not taxable on Riziki Insurance Company. Again, I repeat, dividends from a Ugandan company are exempt dividends, therefore not taxable on Riziki Insurance Company. Two, dividends received from a local company are qualifying dividends because withholding taxes have already been deducted. So you can say dividends received from a local company are qualifying dividends, hence not taxed beyond withholding tax. Dividends from local company are are qualifying dividends, hence not taxable beyond withholding tax. We go to other incomes, if they are there. We have what they are calling commission on reinsurance ceded. That is a taxable income. Commission on reinsurance ceded. So that reminds you to be able to understand what we call commission on reinsurance ceded and commission on reinsurance accepted. So commission on reinsurance ceded is a taxable income. Commission on reinsurance accepted is an allowable expense. We bring it here. We say commission on reinsurance ceded. For motor vehicle, we have 700. This is 300, a total of 1 million. Any other income? We do not have any other, so we can get total income. Total income. So remember, we are asked to get total taxable income of the company. So we are basically interested in this column here. So we have 1790 plus 2400 plus 894.71 plus 1 million. That should be 6,084.71. That becomes the total income of the business. Because we are using the gross profit approach, we move to the next step and say less allowable expenses. We only use those that are allowable. So we go to the addition information 1. which is about claims. So we run claims as working 1. So I want to run working 1, which is about claims. So I can do it here, then we shall wrap. So working 1, claims. So we run claims account. Claims account. So we start with motor vehicle. We are carrying 3 zeros. So if you look at the trial balance keenly, we have what they are calling claims outstanding as at 1st January 2021. That is accrued claims brought down. So motor vehicle, we have 1.1 million. So we write here, balance brought down 1.1 million. Then have balance carried down, information 1. Claims outstanding as of 31st December 2021 amounted to 750,000 for motor vehicles. So we write here 750. Then we debit the account with the claims paid. So we write here bank. So claims paid for motor vehicle is 2770. 2770. Balance of the account. We do it together. 2770 plus 750 is 3520. 3520. Income statement, that is allowable claims, will be that minus 1100, which I get to be 2420. So that will be the allowable claims for motor vehicles. We do it for fire, claims account, fire, insurance. The same procedure with the same rules. Balance brought down, that is accrued claims at the beginning of the year. For fire is 840,000. Balance carried down, that is information 1, is 480. Claims paid, bank, fire is 2110. Balance of the account, 2110 plus 480 is 2590. 2590. Income statement, that is allowable claims for fire insurance, index 840, 1750. And with that we have the allowable claims. So here we have 2420. Here we have 1750. Get the sum of the two. I get 4170. And with that we are done with the claims. We are done with this working, so we can grab it. We move to other allowable expenses. We have information 3, which is about investment allowance. So I said those are allowable instead of depreciation. So we write here investment allowances or capital allowances given at 1.2 million total for the year, that is. Information 4 we have talked about, that is the analysis of investment income. Information 5 is about investment managers fees paid. So investment managers fee, a total of 750,000 for both. And up to there we are done with the additional information. We go back to the trial balance and identify any other allowable expenses. So be very keen. 1, we have commission on reinsurance accepted. Commission on reinsurance accepted. For motor vehicle is 600, fire 200, a total of 800. Next we have sundry receivables, that is a balance, not an expense. Bank balance is a balance, an asset, not an item, not an expense. We have directors fees. This is a company, so directors fees are allowable expenses. Directors fees is 495 in total. We bring it here, 495. Reinsurance premiums paid, we have dealt with. Claims outstanding at the beginning of the year, we have dealt with. Claims paid, we have dealt with. Legal costs on claims are allowable expenses. Legal expenses on claims. Motor vehicle is 280. This is 130. 130 plus 280 should be 410. 410. Sundry expenses on motor vehicle claims are allowable expenses. Sundry expenses on motor vehicle claims, a total of 220. Nil for fire, so total is 220. Management expenses are allowable expenses. So management expenses. Motor vehicle 450, 380. That should be 830. Investment income we have dealt with. Premiums returned we have dealt with. Profit and loss account is a balance, not an income, not an expense. So up to there, we can now get taxable income. So taxable income will simply be total income less total allowable expenses. So there are two ways of doing it. You can either deduct each of these from the total income, so that would mean we bracket each of them, or we can get total allowable expenses, have it here, then we deduct it from our total income. So let's use the first method. Good. So this is what we are interested in. So we get total taxable income. Be very keen. So taxable income is total income less allowable expenses. So we have 84.71 less, we are here, 4170, 1200, 750, 800, 495, 410, 220, and 830. 830. I have 279, 2790, 2790.29, but negative. So in short, this company realized a loss during the year 2021. So that is part A, Roman 1. Part A, Roman 2 is asking, compute the tax payable, if any. Tax payable, if any. Now, tax is imposed on income. And for a business firm, income is basically profit. So because this particular firm made a loss or realized a loss in this particular year, it is not liable to any tax. So we simply give an explanation for that. So we say part 2, you can write, Riziki Insurance Company Limited is not liable for taxation for the year 2021 because it realized a loss and not a profit. So the company is not liable for taxation in the year 2021 because it realized a loss and not a profit. Then you can go ahead and say tax is imposed on incomes or profit, that is for business purposes. Tax is imposed on income, in bracket profits, but not losses. Yes, so that explains why for this particular year, this company would not have to pay any corporation taxes. And that marks the end of part A of question 4. The topic being tested here is advanced taxation of business income, that is advanced aspects of taxation of business income. The topic is a must in the exam, and in each paper you'll meet at least 2 questions from that particular topic. So be very keen and make sure you understand every bit of it. With that, I want us to move to part B of question 4. Let me wrap this. Part B of question 4. Now, part B of question 4 is a mathematical question again, testing VAT. So that reminds you to have VAT at your fingertips. Know the theory around VAT, it's so much, and then know how to compute VAT and the applicable rules. So I read, be very keen. Zawadi Associates provides consultancy services to various clients whose terms of contract allow clients to pay for the services either before or after the provision of the service. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. The following information is provided regarding the firm's transactions for the months of October, November, and December in the year 2021. So we have a table of 4 columns. The first column is the nature of the service or transaction. Second column is value of the transaction. The third column is service provision date, and then the last column is payment date. So we have a number of transactions and then all those details. Additional information 1. Silock Investments was declared bankrupt on 30th November 2021. Now, Silock Investment was one of the customers, one of the clients, and we are told it was declared bankrupt on 30th November 2021. Let's look at the table and understand what happened in that transaction. So the transaction was management consultancy to Silock Investment. The value of the service was 1,440,000. The service provision date was 13th November 2021. Payment date was 40% paid on 30th November 2021. 40% paid on 13th November, meaning 40% of the amount was paid on the service delivery date, and the rest was to be paid later. Then come to information 1. This client was declared bankrupt on 30th November. What does that mean? If a debtor is declared bankrupt, it means you cannot recover the debt from them. So it means you have to write it off. And that means you'll have to, it will reduce the amount of VAT you'll collect from this debtor. So what we do is simple. We shall show this as a transaction, yes, but it will be a reduction under output tax. 2. On 5th November 2021, Zawadi Associates renewed its National Industrial Training License for 30,000 shillings and paid for legal fees of 360,000 shillings to follow up on clients who were not paying as per the agreed date. So it had 2 transactions. One was renewal of industrial training license fee at 30,000. Then 2, it incurred a legal fee of 360,000 to follow up on clients who are not complying with the terms of the contract. So we have to determine if these are vertible or non-vertible items. Now, renewal of industrial trading license fee is not, renewal of national industrial trading license is not a vertible item. So yes, this is an expense, but it will not attract VAT. Legal fees are professional services, and so they will attract VAT. 3. Electricity bill paid on 10th November 2021 was 270,000, out of which 100,000 shillings was payment for outstanding bill for October 2021, and 20,000 shillings was in respect of additional deposit as demanded by the power company. So let's get it keenly. Total amount paid was 270,000 on 10th November. 100,000 out of that was payment for October, and then 20,000 was a deposit for the following month. Now, what does that mean? It means, in short, Not the entire 270,000 was relating to November. So what we shall do is simple. We are going to explain what we call tax point. And in this case, we shall have to split this 270,000 for 3 months. 100,000 for October, 20,000 for December or after November. Then the difference, that is 270,000 minus 100 minus 20, that should be 270 minus 120, which is 150, is the amount relating to November. Good. For fuel consumed for partners' vehicles amounted to 90,000 during the month of November 2021. Fuel is a vertible expense, and so we shall charge VAT on that. So we are told it was 90,000, and we are told it was for partners' vehicles. So this means it was for business purposes. Remember, one of the rules in VAT is you can only claim input tax on business expenses or business items, but not private or personal expenses. Computers purchased for business use cost 240,000 in November 2021. Again, this is for business, and so it will attract VAT. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Zawadi Associates paid rent for the month of November 2021 amounting to 180,000 on 5th November 2021. Now, rent is not a vertible item, so we can show it, yes, under input tax, but the rate will be nil. It is an exempt item. 7. Transactions have been stated inclusive of VAT at the rate of 16% where applicable, unless otherwise stated. Now, when computing VAT, the figures given may be inclusive of VAT, to mean the figures already have the VAT amounts within them. So that means if the VAT rate is 16%, then the figures are at 116%. So in that case, be very keen, the VAT rate applicable will be 16 out of 116. So this is where the figures are given inclusive. But where the figures given are exclusive of VAT, it means they do not have the VAT amounts within them. So the figures are around 100%. So it means the VAT rate will be 16%. So this is exclusive. Be very keen on that. Many students confuse the two and they end up with wrong figures, and that makes them fail. Required. 1. Compute the VAT payable by or refundable to Zawadi Associates for the month of November 2021. November 2021. So remember, we have transactions affecting, or rather touching on October, November, and December. So the question is, compute the VAT payable or refundable to Zawadi Associates for the month of November 2021. Now, this means we have to understand something called tax point. Now, tax point in simple terms is simply the date or the time when VAT is deemed due and payable. The date or time when VAT is deemed due and payable. Now, for local supply, that is for transactions within the country, tax point is the earliest of 4 dates. The earliest to mean that which comes first. 1, the date the services are supplied or the products are supplied or sold. 2, the date when the date when an invoice is issued or received. 3, the date payment is made for part or full settlement of the transaction. And 4, the date a certificate is received. That is in case of transactions requiring supervision, like in constructions where an architect certificate has to be issued and all that. So what we do is simple. Look at each and every transaction, locate the tax point, and if the tax point is November, then we shall capture that transaction in November. If it is not in November, we shall leave it out, because the question is, we compute the VAT payable, refundable for the month of November. So let me use the first transaction, for example. The first transaction was audit services to XL Supermarkets. Audit services to XL Supermarkets. Value of service was 700,000. Service provision date 25th October 2021. Payment date was 5th November 2021. So you can see The service was provided on 25th October, but then the payment was on 5th November. So what does that mean? This transaction should be captured for VAT purposes in the month of October, but not November. So what we do is simple: analyze each transaction, then locate the tax point. If it is within November, capture it under November. We answer that. So this is question 4B. So we say Zawadi Associates value added tax computation for the month of November. For the month of November 2021. So we start with output tax. Output tax is the VAT on sales. Output tax. We arrange it like this. We have date, we have details, we have gross amount in shillings, VAT rate, then VAT amount in shillings. So remember, we have to determine the tax point. So transaction 1 was audit services to XL supermarkets. The service provision date 25th October. Payment date is 5th November. So that was captured in October. We don't bring it under November. Next, we have training services to Kyle Securities, provided on 3rd November and not yet paid for. So that means the tax point is November. So we write here 2021 November. So the date was November 3rd. The customer was Kyle Securities. The value of the transaction was 240,000. And we are told this is inclusive of VAT. So that means the VAT rate is that 16 out of 116. So we do 16 out of 116 times 240,000. I get 33,103. Sorry, 33,000. Sorry, 16 out of 116 times 240,000. 33,103.45. Next, accountancy services to our total children's home on 5th December 2021, the service provision date. Payment date was 20th November. So November comes before December. So tax point is November 20th. Watoto Children's Home. Watoto Children's Home. Now, Watoto Children's Home is, the value is 600,000. This is a service provision to an NPO, a non-profit making organization. So, for such, it is nil. That is nil. Debt collection services to Zoella Computers. Service provision date 9th November. Payment date 30th November. So again, this is a November transaction. We take November 9th. That is Zoella Computers. Zoella Computers. 820,000. 16 out of 116. 16 out of 116. 820,000. I get 113, 103.45 again. Next we have strategic plan development to Bazo That is Rwanda Limited. So the company is in Rwanda. So what does that mean? This was an exported service. For exports, we know VAT rate is nil, is 0%. So we write here, the service provision date was 10th November, not yet paid for. So it means it is a November transaction. So we say Bazo in bracket Rwanda Limited. The amount is 2,150,000. The rate is 0%, meaning the amount is 0. We have management consultancy to Siloc Investment, service provision date 13th November, 40% paid on 13th November, the rest not yet paid, meaning it is a November transaction. The tax point is in November, that is. So we write here Siloc Investments, 1440,000. 16 out of 116. 16 out of 116 times 1440,000. I get 198 620.69. 620.69. Lastly, we have financial consultancy to W. Before that, we have internal controls reviewed of Lema Limited, value 960,000. Service provision date 18th November, but then payment date was 7th October. So it means the payment came before the service provision date. So that means the tax point is in October. So we don't capture that in November. Lastly, we have financial consultancy to W Limited. Service provision date 20th November, payment date 1st December. So we pick 20th November. So we say W Limited, 1.2 million. 16 out of 116. 16 out of 116 times 1.2 million. 165,000 517.24. Then we have information 1, that is Siloc investment being declared bankrupt on 30th November. So that will reduce the VAT from that in client. So let's understand it. When the service was provided on 13th November, 40% of the amount was paid. That is 40% of 1440,000. Then the rest was not yet paid. And this is on 30th November. So we are not losing the entire amount. What we are losing is simply the VAT on 60% of 1.44 million. So that is what we need. So 60% of 144 million, I get to be 864,000. We should deduct times 16 out of 116. I get 119, 172.24. We deduct because it was a loss, a bankrupt issue. All the rest are transactions affecting input tax. So up to here we get what we call total input tax. Total output tax. That is total VAT on sales. We be very keen. 33,103.45. 113, 103.45. 198, 620.69. 165, 517.24 less 119, 172.24. I get 391 172.59. That gives me total output tax. That is step one. Step two is to get out input tax. That is the VAT on purchases and expenses. The same arrangement. So, but we are getting input tax. So we are going to follow the same procedure. But now we are looking at expenses and purchases. Again, we must be keen on which expenses and purchases attract VAT, which ones do not. So I move to information 2, which is about renewal of National Industrial Training License at 30,000 and then legal fees of 60,000 paid on 5th November. So I come here, right, 5th November. One, we have National Trade Industrial Training License at 30,000. That does not attract VAT, so the VAT rate is nil. Still on the same date, there was legal fees incurred or paid of 360,000. Legal services are professional services attracting VAT, so 16 after 116 times 360,000 should be 49,655.17. Information 3 is electricity paid on 10th November. So we write here electricity, but we have to break down the figure. Total amount paid was 270,000. 100,000 out of that was for October, then 20,000 was a prepayment for December, meaning the amount relating to November is only 150,000. So write that. Electricity is a variable expense, so we charge. So 16 out of 116 times 150,000. I'm getting 20,689.66. 4, we have fuel for the partners' vehicles at 90,000 paid in November. So we can write here 10 fuel. That is at 90,000. Fuel is a petroleum product. Petroleum products attract VAT currently at 8%. So if this is inclusive of VAT, it means it will be 8 out of 108. So we shall have 8 out of 108 times 90,000. That is 6,666.67. Then we have computers purchased in November at 240,000 for business purposes. So computers 240,000 for business purposes. I am getting 33,103.45. Note 6. Zawadi Associates paid rent for the month of November amounting to 180,000 on 5th November. So rent is not a variable expense. The amount was 180,000. The rate is nil. The amount is nil. Transactions have been stated inclusive of VAT. So up to here we get total input tax. Total input tax. The sum of all that, 49,655.17 plus 2689.66 plus 666.67 plus 33,103.45. I get 114.95. That is total input tax. The next step now is to compute VAT payable or refundable. Now in this case, this trader had both taxable supplies and non-taxable supplies. So what we do therefore is to restrict the deductible input tax. So we say VAT payable or refundable is equals to output tax less deductible input tax. Deductible input tax is equals to taxable supplies divided by total supplies times input tax. Taxable supplies are simply those supplies attracting VAT, that is, sales at standard rate and sales at zero rate. Total supplies will be taxable supplies plus now the exempt sales or those sales attracting VAT at nil rate. So we go back to our output tax table. So if you are keen, we have supplies attracting VAT at standard rate, those at nil rate and those at zero rate. So to get the numerator here, this figure here, we add all the transactions attracting VAT at at zero rate and at standard rate. So look at the table keenly. We pick everything, that is the gross amount for every transaction, except those attracting VAT at nil rate. So if you are keen, if you are there, we have the list. There is one transaction attracting VAT at nil rate, that is the supply to Watoto Children's Home, which I said is an NPO. So it means we get the sum of everything except that 600,000. So do it with me. We have 240,000 plus 820,000 plus 2150,000 plus 1440,000 plus 1.2 million, then minus 864,000, that is the budget written off. So I get 4986,000. So we say this is equals to 4986,000. To get the numerator, simply add exempt transactions to that figure. And in our case, we only have one of 600,000. To that figure, we add 600,000. I get 86,000 times input tax. Input tax is here, 114.95. So we get it together. So we have 4986,000 divided by 5586,000 times 114.95. I get 98,287.35. Therefore, we say VAT payable. It is VAT payable where the total output tax, our total output tax we got to be 391,152, is more than the deductible input tax, which is 98,287. Where it is the other way around, it becomes VAT payable. So we say VAT refundable. So we say therefore VAT payable will be equal to 391,152.12 minus 98,287.35. We do that. So 391 152.12 minus 98 287.35. I get 292 864.77, and that becomes the VAT payable for this particular month of November 2021 by this firm. And that marks the end of question B, part 1. We move to part B, Roman 2 of the question. It says, Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Zawadi Associates is planning to engage a firm of financial management consultants from South Africa to facilitate online training on financial management assignments. Advise Zawadi Associates on the tax point in respect of such services. Advise Zawadi Associates on the tax point in respect of such services. This is again touching on what we have been talking about. Now, in this case, this company is planning to engage a firm of consultants from South Africa. So what does that mean? It means, in short, it will be importing this particular service from South Africa. Now, the rule is that for imported products, that is for imported goods and services, tax point is the earliest of 3 dates. Earliest of 3 days. Number 1 is the date when the service is provided. 2, the date when payment is made in full or part settlement for the contract. And 3 is the date when the invoice is issued. So in short, you can say tax point for imported services is the earliest of the following 3 dates. Tax point for imported services or products is the earliest of the following 3 days. 1, the date when the services are rendered or provided. 2, the date when an invoice is received. And 3, the date when payment is made in full or part settlement for the contract. So in short, for Zawadi Associates, the tax point, that is the date when they will have to account for that particular transaction under VAT, will be earliest of those 3 particular days. And that earns you the 3 marks awarded there. And that marks the end of question 4. Yes. Again, that reminds you that VAT is a very common exam area. Be very familiar with it, know the theory part of it and the computation part of it. The rules as well around VAT computation. A very important part is to know the classification of supplies. We know not all supplies are VATable, so we should know which supplies are VATable at standard rate, which ones are VATable at 0 rate, and which ones are VATable at which ones are exempt supplies. Yes, and that is it.